Okay, good afternoon and welcome everybody to this quarter's edition of Making Sense of the Markets. We appreciate you taking the time to join us once again, and as we are on the heels of yet another interesting quarter, and we know many of you have questions on your mind about how 2022 will impact your portfolio, but also what can we expect in 2023. So we again look forward to taking some time to address those questions with you today and appreciate you taking the time to join us. You know, it continues to be an interesting time from a headline perspective. It seems like we can find headlines relating to or referencing the Federal Reserve at every turn. And obviously we'll continue to keep a very close eye on the Federal Reserve as it relates to interest rates and the impact on inflation. And then we continue to keep an eye on all the other challenges people are facing around the country and around the globe. And certainly we can all find whether we're trying to travel, or for those of you who are living in California and trying to get around or to get through another natural disaster, we know that we're all facing challenges each and every day, and certainly look forward to finding additional opportunities for us to all fight through all those. It's really easy in these challenging times to see things from more of a glass half empty perspective, certainly. I don't think we have very many people on with us today who have had the fortune of being able to lose $182 billion recently, but we know that that's one perspective. Certainly things can be harder for some of us than others, but also as we look at things from a relative perspective, and we're going to be talking quite a bit today about our expectations moving forward and what 2023 looks like, we certainly could continue to see a very difficult time, and including the fact that there are some expectations that the stock market, at least, could be outperformed by the European stock market in this current year. However, here's another way to look at it, and we'll talk about this and you'll see these themes throughout our conversation today. 2022 was an incredibly difficult year in so many ways, but one could argue that it was also a year of ripping the Band-Aid off, taking more of the pain we were expected to face over a longer period of time and merely accelerating when we would experience that. And so as you look at this picture in front of you, and you'll see this again later from Eric, and he'll talk about it further, but the expectations in these little tiny dots on your screen is where we face looking forward expectations earlier last year. And as we move through 2022, and as we endured more of that pain, as we looked forward, we saw the expectations move to the right on the page in front of you, which means we have better and stronger expectations in the future. So again, I don't want to steal Eric's thunder on that point. I know he'll have some commentary on that for us. So here's what we have presenting for you today. We're joined again by Scott Duba, the firm's Chief Investment Officer and Managing Director of Wealth Management. Many of you know Scott from our prior presentations and understand he's got not only incredibly high intellect, but understands how all of these issues can trickle down to impact each and every one of you without regard to what your situation is. Some of you may have seen or heard Scott quoted in the Wall Street Journal talking about corporate earnings expectations earlier this week, in fact. So we're fortunate to have Scott with us. And then Eric Kraus, and I know Eric tires of hearing me say this, that he cut his teeth out working with retirement plan participants and investors out behind the windshield on airplanes, meeting with people across the country. But now Eric's able to take all that experience working with people like you, and then to add to that his investment expertise, and I think he has a good perspective to share with each of you. And then I'm Matthew Eichmann, our National Retirement Practice Leader, and I'll be kind of helping us through our agenda today. So before we turn it over to Scott and Eric to really dive into the markets and the economy, we know that very common questions we have for many of you, are there any big tax law changes that I need to be aware of for 2023? And I promise you we won't go through each and every one of these. We'll have more opportunities to learn about these tax law changes as we move through the next couple of months. But we did want to just give you a really quick taste. So as you think ahead for various reasons for optimism, and as you start to chart your course for saving and investment purposes in 2023, here are some of the things that you should keep in mind. First of all, when it comes to your retirement plans, you're going to have additional opportunities to be able to save. And some of that is because the amount of compensation that is counted for retirement plans increases. So if you're a high earner and you previously were limited in what is taken into account, that limit increases dramatically for 2023. In addition, if you're a retirement plan saver, the amount that you'll be able to save will increase within your 401k or your 403b plan as a result of inflation and the cost of living adjustments. Now, you can see down here below, if you are an IRA saver, there is a slight adjustment in the IRA contribution limit for this year. Not as dramatic as what you see within employer-sponsored plans, but an increase nonetheless. The total amount that can go into a retirement plan increases by $5,000. The highly compensated employee threshold, which can limit what some people can save, increases significantly. And for those of you who have been taking advantage of health savings account or HSA savings opportunities, that amount goes up pretty considerably this year as well. So the moral of the story there is that as a result of inflation, the IRS has increased many of the caps that otherwise would have limited the amount that you can save in 2023. Now, in addition, many of you may be aware that Congress came together to pass a significant tax bill and retirement plan legislative package in late December of 2022, and it's called the Secure Act 2.0 of 2022. And you can see down here a QR code as I talk through just a couple of highlights. If you want to capture a picture of that and you want to take the opportunity to register for a webinar we have next week, we'd love for you to join us. But here's the general essence there. There are a handful of changes that immediately impact you from a tax perspective in 2023. You know, first of all, if you were not yet 72 at the end of 2022, then your required beginning date, which is the date by which your required minimum distributions have to begin from a plan or from an IRA, is going to be pushed out even further to 73 and eventually out to 75. This is pretty important for many of you from a tax planning perspective, and we'll talk more about this throughout the year. In addition, employers now are going to have the opportunity to give you the option to elect for your employer contributions to be deemed as Roth contributions. We don't expect a lot of that will become available this year, but just know that you're going to have expanded opportunities for Roth contributions as we move forward. Simple IRAs and SEP investors now have that ability to elect Roth contributions. And in addition, employers who are trying to incentivize and motivate some of you to start to save within your retirement plan can now offer you de minimis gifts like gift cards, for example, to try to entice you to participate. Now, coming up in later years, and so we're not going to spend a lot of time on these issues today, but you're going to hear about these. You'll read about this within the headlines, that the ability for employers to start to match student loan debt repayments, the ability to offer in-plan emergency savings accounts, expanded access to Roth contributions in the form of Roth catch-up contributions, which will be required for higher paid employees, the ability to take excess 529 plan amounts and move those over into Roth IRAs, higher catch-up limits in 2025, and more coverage of long-time part-time employees beginning in 2025. So that's just a real quick look at the Secure Act. Like I mentioned, join us next week if you have the opportunity. But I think, Scott, more people are here to hear from you and Eric. And I think they want to know a little bit more about what 2023 looks like. But I don't think we can really start to look forward until we can look back at 2022 and say, what the heck happened and how did we get to where we are? So why don't you walk us through kind of your outlook, looking back at 2022 for a bit, but also what you expect in 2023.
Sure, Matthew. So if we look back at 2022, you know, some of this might be common knowledge amongst certain participants, but we'll review nonetheless. The main story was inflation. It proved to not be transitory, unfortunately, as opposed to what the Fed had been telling us in 2021. And the Fed responded aggressively and appropriately with over 400 basis points of rate hikes. That obviously had an impact on GDP growth, which was extremely strong in 2021 at close to 6%. It should come in for 2022 closer to 2%, really as a function of the tighter financial conditions taking hold and tamping down demand as the Fed intended. The other thing that I would note is that S&P earnings also slowed from a breathtakingly fast pace of growth in 2021 to a still strong but more moderate growth in 2022. We saw nearly 40% earnings growth in the S&P 500 in 2021, coming off of the low earnings of 2020. Yet again, because because the economic growth was slowing in 2022, not surprisingly, that growth moderated over the course of the year and is actually looking like it'll show year-over-year declines in Q4 of 2022. The other point I would make is that valuations reset tremendously from what I would call rich levels in 2021. In late 2021, the S&P 500 was trading at about 26 times earnings, whereas now at the end of 2022, we're trading more at about 18 times, which we'd characterize more as fair, as it's more in line with the historical averages. And obviously that come down in valuations was a function of growth and rate concerns. The other main development was bond valuations. This wasn't just a reset in the equity markets, but most impactfully, at least from our perspective as managers of money, it was the impact on bond portfolios as well. Case in point, the U.S. 10-year Treasury yield increased from 1.5% in late 2021, 10-year 4% in 2022. And again, that's in response to the Fed hiking the short-term rates. So what was the net impact of all this? Well, we had the S&P down about 18% and the bond market aggregate down about 13%. So as opposed to past bear markets, or rather market declines, we had a coordinated decline in both the equity and bond market, which really sets up the stage for an interesting 2023. If you put last year's performance in equities and bonds in context, it's extremely rare. As you can see on this chart here, the top bar charts show the percentage return in the S&P 500 dating back to the mid-70s, and the bottom chart shows the same for the bond market back to the mid-70s. And as you can see, there's relatively few down years in the bond market in particular. Obviously, there's been drawdowns in the equity market, but what's telling about this slide is that in 2022, you had both stocks and bonds down more than double digits, which is very rare and really kind of sets up an interesting dynamic for the balanced portfolios that we generally manage going forward, which Eric will address in a few slides. If we turn the page and look towards 2023, we have some high-level observations, which are a summary of kind of what we're looking for. In general, we're going to have continued rates rising, as the Fed has well telegraphed. We're going to have growth slowing. We do expect inflation to fall, but importantly, sentiment's already weak, and we think markets will start to recover. If we look particularly at short-term rates, we think the Fed will continue to raise the Fed funds rate and peak in the low 5% range. And we do expect inflation to fall as measured by core PCE, which is the Fed's preferred measure. We think it'll fall towards 3% by year end. That's still going to be above their 2% long-term target, but that'll represent some market improvement from what we saw in 2021. For real GDP growth, we do expect it to slow, and it will approach what we think will be close to stall speed. And importantly, markets are already assuming about a 65% chance of recession. As for corporate earnings, we expect those to move lower as well through a combination of both slowing top-line growth and margin pressure from obviously wage pressure and less operating leverage as top-line slows. As for valuations, we don't see very many obvious bargains across markets, but we do expect the valuations will remain better than we saw them in 2021. As for sentiment, at present, it's very weak. And we think that bodes well for returns from where we are today, somewhat irrespective of the exact trajectory of the macro picture. Another point to make is the history of bear markets. We've done a fair amount of work around looking at past bear markets in the U.S. economy. And generally what you see is that over the longer term period from when a bear market first starts, over the next 2 years, returns are generally better. But investors have to have patience because it's often a bumpy ride back to that better level. And in general, our strategy is to stick to our long-term allocation strategy and consider adding risk exposure if appropriate. There's certain pockets of the market where we're seeing opportunities and we're tactically taking advantage of those. If you look at the bar chart on the bottom, this shows sort of normalized yields and earnings yields on stocks and bonds. we see interesting opportunities in higher grade credit, as well as some of the international equity markets, which have sold off more so than the US markets and offer some compelling opportunities. But we're mindful of the macro risks. So our general strategy coming into 2023 is to respect the history that bear markets tend to be a good opportunity to add high quality assets and sort of remain ready to act when we see conditions start to flip in a more positive way. And then if we flip to this next slide, this weighs heavily on our positioning, our decision making. Investor sentiment, when you look at it, it's a good representation of how much negativity is priced into the market. One survey that we track is the American Institution of Individual Investors, and they have monitored investor sentiment all the way back to 1987. And when we analyze the data, what you see is that when these sentiment readings are in the bottom decile, if you look at the table on the right, returns tend to be better over the next year than when the sentiment readings are higher. And that makes intuitive sense, right? If everyone is very positive and bullishly positioned, there's not much additional capital that could flow to risk assets. However, in times like these, when there's a lot of negative sentiment and positioning is pretty light, even marginal improvements in the outlook can have big impacts on future returns. And if you look at the bottom right-hand corner of this table, you'll see that when readings are in this lowest decile, S&P 500 returns over the next year have averaged 15%, which is markedly better than the long-term average. And as it stands today, for the past few weeks, those readings have been consistently in that lower decile. So while it's often difficult and sometimes nerve-wracking to allocate to risk assets at this point in the cycle, historically it's paid out. It's paid off over the next year. And so that's one of the things we keep in mind when we're monitoring all these factors, is that as bad as things might look, what matters more for our prospective returns is how much of that is priced into the market. And based on this, we think there's a fair amount of negativity already priced in.
So I think, Eric, what Scott's telling us is the emptier the glass is, the fuller it really is, right? And so we can certainly find opportunities to find reasons for optimism and good news within bad news. It's probably a good opportunity for you to elaborate on some of the points that I teased earlier, and helping everybody to understand how the performance and the challenges we saw in 2022 are expected to impact us in a predominantly positive way when we look ahead in terms of long-term potential.
Yeah, just to kind of tie that all together, if you've been on these webinars for long enough, you're probably tired of hearing me say this, but it's just a helpful reminder that the market is not a temperature reading of current economic activity. It's a forecast of the next 3 to 6 months. So that's why Scott reviewed still a pretty strong 2022. Earnings weren't bad, unemployment still historically low. The markets were down 20 to 25% at one point. How's that happen? It was the market's predictions of some potential trouble this year. So to Scott's point, perhaps that's the best time to be opportunistic, or at least be positioned to be opportunistic once we do see the full impact of all this Fed tightening. But the biggest impact to me, it's our job, of course, as investment managers to pay attention to what's going on short term and make tactical adjustments where we can add value. But for long-term investors, we don't make a financial plan on what's going to happen in the next 3 to 6 months. We look out 5 to 10 years, or even 20 years, 30 years throughout someone's retirement or their plan for retirement. And this was fascinating to me when we pulled these slides together, because this slide on the left-hand side, this little chart here from Vanguard, was something that we included in our review materials in the first quarter of 2021. And it was kind of depressing when we talked about these forecasted return expectations. If you look on the left-hand side there, I recognize that that's very small, but this is not a short-term performance projection. This was a 10-year performance projection that showed Vanguard's estimates of US stock returns were going to be 2 to 4% per year for 10 years. Again, historically low levels that we faced in 2021. It wasn't much better in bonds. To Scott's point earlier, the 10-year treasury yield was only at 1.5% when we started last year. So those return expectations for bonds couldn't be much higher, 1.5 to 2.5%. Blend that together, that algebra doesn't work to build a very diversified or otherwise. It doesn't work to build you a long-term successful return pattern. But fast forward just 12 months, and again, I think Matthew used the term rip the Band-Aid off, as painful as that might be. It's actually given us a pretty healthy reset for what we might be able to expect in the financial planning process on a forward-looking basis. And Vanguard is still probably among the more conservative institutions that we've highlighted here. They're forecasting now closer to a 5 to 7% return on stocks, which is not bad on US equities. Opportunities perhaps still in international equities, down a little bit lower, where we're seeing 7 to 9% forecasted for both developed and emerging international markets to potentially add some benefit from that diversification. But the biggest change to me really comes in this fixed income sleeve. So it's great if equity markets are doing well and you're an aggressive investor, but if you're a more conservative investor and you don't want to tolerate that risk, you haven't had any alternatives. And we'll get into this a little bit more later. But the huge bump in interest rates has caused that return projection for aggregate bonds, or kind of the bond index, if you will, to be closer to 5% on a forward-looking basis. So those are tools that you can work with and tools that you can count on regardless of what happens, hard landing, soft landing. How long does it take for things to turn around? Over the next 10 years, we feel much more confident about the return expectations for the market. And just to further drive that home, that's echoed here from JP Morgan and BlackRock, two other kind of highly regarded institutions at this long-term capital market assumptions game. A lot of data on the page, so I'll just kind of highlight some of the key things here. That orange line at the bottom of the left-hand side there shows essentially the potential for return that you would get for any unit of risk that you might take in the most efficient manner. We call this the efficient frontier. And last year, what it showed, again, was that there really wasn't much you could do to make much of a return in a diversified portfolio. But this blue line that's adjusted up here, the summary of this suggests that if you had a diversified 60-40 balanced portfolio, instead of expecting a 4% return on a forward-looking basis, we're looking at closer to 7.5 to almost 8%. And that's exactly what the chart on the right-hand side shows as well. I know we can't read that, but it's just to further illustrate that there's a lot of consensus here. Again, there's consensus of negativity. I think Scott's going to show us the highest forecast on record, not in a recession, of when people think we're going to have one. So it's easy to get caught up in the negativity. But the institutions and the people that really crunch the numbers of the long-term valuations of the markets are also aligned that we have a better path forward here.
Yeah, thanks, Eric. That's really helpful. And I think that's a natural place for us to talk a little bit about the labor market and unemployment numbers. I think the data is particularly challenging for us to all understand. It seems like it would be a great thing to have incredibly and frankly ridiculously low unemployment, and then it would always be a great thing for people to be able to have all the jobs that they want and then some. But it actually seems like maybe that's not the case for us from a macroeconomic perspective. So can you help us to kind of better understand why the Fed might be rooting for some developments that may not seem positive at first, but probably are in the long run?
Yeah, we've seen that. We've seen some reactions in the marketplace too, where we're in this bad news is good news mentality. And ultimately what that comes down to is inflation is truly just a matter of an imbalance between supply and demand. Whether that imbalance is too much money chasing too little copper or too little oil or too little natural gas, that impacts prices. It drives those prices higher. That's also present in the labor market. So if we flip forward to this left-hand side of the slide here, that's exactly what we're trying to illustrate. Right now, there's just simply not enough supply of labor to meet the immense demand that this robust economy has delivered. So this 1.72 number that was reported here, that means that there's 1.72 job openings per person looking for work. So labor absolutely has the upper hand to be maybe a little bit flighty, to job hop. That's very difficult for companies to endure when they hire people and then they're out the door 12 months later. To negotiate higher wages. And again, we're all for people making more wages, especially some of those sectors that maybe were underpaid for many years and are finally coming to life in the service sector. That's great. But the challenge is when we have this huge imbalance of supply and demand, all that ultimately ends up flowing back through into higher prices, higher goods prices, higher service prices, higher rents. So that's why the Fed seems to think that we need to get this under control. Now, I will note that we have seen some signs of progress. So obviously that chart on the left you can see is hooked down just a little bit. And then at the bottom right-hand side with layoffs, again, you hate to call layoffs progress, but out of the technology sector and the financial sector, you're starting to see those headlines of those companies that sort of went into this land grab of labor, of hiring as anyone that could get their hands on in the last couple of years, are starting to tighten the belts a little bit to say, hey, we may not make as much money this year, and one thing that we can control is our hiring. So you're starting to see those layoff announcements from the Amazons of the world, the Metas of the world, the Goldman Sachs of the world. But we do expect that may start to filter through broadly to the economy. But if we look at the next page, this is again where we started to see Perhaps the trend head in the right direction. And frankly, this is why I think the markets are up so far this year, is we had a wage growth number, which is what the Fed is focused in on now, that wage growth figure in the labor market, that's starting to trend back down. And that's what's reflected in this blue line here. And I don't want to oversimplify this, but the blue line represents wage growth. Historically, it's averaged around 4%. We're, of course, well elevated above that still, even though we've turned back down. And that's overlaid with the unemployment rate, which has actually historically averaged 6.2%. But ultimately, our expectation here is if you look at the past, these lines tend to spread apart and then they come back together. And we went to the situation where wage growth got very high, unemployment went very low, and we're starting to see those come back together. And of course, the Goldilocks scenario would be if we can close that gap of jobs available to the number of workers without a whole bunch of people having to lose their jobs, and that we can sustain some healthy wage growth, but more at a sustainable level. So closer to that 4% range that historically we've been in the ballpark of. So more to come there, but certainly Scott and Matthew, welcome any of your thoughts there as well.
No, I think you said it well, Eric. You know, the Goldilocks scenario is exactly how you describe it. If we were somehow able to reduce the number of job openings and reduce the demand for open jobs without impacting unemployment, that would be great. But historically, that's been very difficult to execute. And so us, as well as most other forecasters, assume that unemployment will rise somewhat, depending on how much the Fed is going to have to do to bring inflation under control.
And so we know the Fed needs to do that. We want the Fed to do that, but help us understand, Scott, you know, the implications if it's unable to, or if it's just not quite as successful as we would like the Fed to be.
Yeah, I think it's not a question of if they can't get it under control. I think they certainly can. It's just more a question of how much pain are they willing to put the U.S. economy through to accomplish that. You know, we do expect the Fed's currently restrictive monetary policy to remain in place for all of 2023. You know, core CPI has continued to show some signs of cooling, but that's largely been driven by goods as opposed to services. Services being more wage-based, to Eric's point about the still remaining pressures there. What's also helping is a moderation in commodity prices, transportation costs, and import prices. So those should help goods inflation as well. But, you know, in services, it's been less pronounced, particularly in shelter and healthcare. Those still remain pretty sticky in terms of inflation drivers. Right now, futures are currently pricing an additional 2 25 basis point hikes in both February and March, which will bring the total tightening campaign from 0 to what we think will be about the top to 475 to 500 basis points. And so the futures market is right now assuming the Fed funds rate goes to 5%. And we would expect them to keep it at this level through 2023. Remember that the Fed has a dual mandate. It's price stability and full employment. For the past 20 to 30 years, they've been able to focus primarily on full employment because there really hasn't been a lot of inflationary pressure. Whereas now that mandate remains, but the priority is very much so still on price stability. And for the long-term health of the U.S. economy, it's better for the Fed to deal with inflation sooner. And that just means that we could be in for more pain if inflation proves to be more sticky than what people are expecting today.
You know, and some of that pain we would associate with the R word, the notion that we would be in a recession, whether we're in one now or we have one forthcoming. Can you talk about that a little bit, Scott, and maybe help everybody try to navigate what it really means for us to be in a recession or not, and whether really that tagline matters as much as some of the related data and then where we're headed as we come out of this current dip?
Sure. So the National Bureau of Economic Research is typically the body that defines a recession, but to your point, it's not an exact and precise definition. And it might have wildly different implications for different individuals. The way we look at it is, you know, what's the base case for the next year? What does a soft landing look like? And what does a hard landing look like? If you flip to the next side, this is effectively the consensus and base case scenario, which is that we should see rates and unemployment rising, inflation and GDP growth falling, but the expectation is for a rather mild slowdown. As we stated earlier, the Fed should raise short-term rates to about 5% or maybe 5.25%, and then hold them there just to see how much progress we make on inflation. Unemployment, we're already seeing layoffs in the tech sector, and we think those will continue to spread to other sectors. And we would think the unemployment rate will rise from about the mid 3s now to something in the high 4s in the base case. The upshot of that is that inflation should decline to about 3% by year end. And that'll be a function of both continued moderation in goods as well as some progress on service inflation. And in terms of overall GDP growth, we expect it to slow down to about flat. We'll probably see at least 1 quarter of a negative GDP print, but the expectation is not for a deep and sustained recession. It's more something of the mild variety when you look at the overall consensus expectations. If you flip to the next side, one of the other scenarios is a soft landing. I'm sure many have heard that term in the press. And that's just a way to say the Fed executes perfectly in terms of what they're trying to accomplish without imposing too much pain on the economy. What that would entail would be inflation falling faster than expected, rates plateauing only at 5% or maybe a little bit lower, with only mild job losses and economic growth staying near the long-term average about 2%. If you look at the table on the bottom, the Fed funds rate might even tick down in Q4. Core PCE inflation should go below 3% by the end of the year. And the unemployment rate in this, what I would say more of a Goldilocks scenario, the unemployment rate would only move up to about 4%, which is still well below the historical average of around 6%. And importantly, GDP growth stays positive, not in the gangbuster growth that we saw coming out of COVID, but still at a healthy 1.5% to 2.5% for the year. Again, this is a soft landing scenario. History would suggest that this is pretty hard to accomplish. Typically, when inflation has overshot the Fed's target by as much as it has in the recent past, this is hard to accomplish. Nonetheless, this is what a soft landing would look like. If you look at the other side, what would a hard landing scenario look like? This would be the case if inflation proves stickier and the Fed has to be more aggressive with rates in terms of trying to tamp down demand. In this case, we probably wouldn't see as much progress on the service side of inflation, and core PCE would stay in the high 3s, maybe 4% for most of the year. The Fed funds rate would probably go to 5.25%, maybe even a little higher, and unemployment would have to rise north of 5%, probably closer to that long-term average of 6%. In this case, it wouldn't necessarily be as mild of a recession. You'd probably see something more akin to a traditional recession of a few down 2 or 3% GDP quarterly prints. Now, the thing to keep in mind here, though, is the Fed has historically had success, when we do enter a recession, seeing inflation respond. So this is, more of a downside scenario where you have GDP growth falling fairly substantially without a move in inflation or a meaningful move in inflation. We think this is relatively unlikely. I would think if GDP is going to go down 3% a quarter for many quarters, it's hard to imagine core PCE would stay this robust at 4%-ish with unemployment rising 250 bips over the course of a year. And when you step back and you look at what's being forecasted in the market, economists are predicting a recession with probably the highest probability we've seen in a long time. This chart shows kind of a composite of recession probability by economists. You'll see that it's at about 65% of economists are forecasting a recession in the next 12 months. That's a very high level. Typically, you don't see it get that high unless we're actually in a recession. Obviously, it went to 100% in 2020 when we were in that recession, as well as in late 2008 during that recession. But right now, we're not actually in a recession. We still have relatively strong GDP growth. We still have very low unemployment, and things are pretty good. So we like to include this slide because it kind of makes the point similar to the sentiment slide that, a lot of these pressures on the economy, a lot of these pressures in the market are somewhat already factored into both economic forecasts and what investors are thinking. So important to keep in mind when you review your positioning. And again, we'd caution anyone getting too defensive at this point when a lot of the bad news is likely pressed in.
So Eric, as we think about making a lot of this practical for investors, whether we're dealing with an individual investor or somebody thinking about a retirement plan account, I think it's natural for people to wonder, what should we be doing if we're approaching retirement? Let's say retirement's right around the corner, and where there are some concerns, perhaps, about a prolonged bear market. How should one deal with that situation?
Yeah, it's a great question. And it's natural to feel that trepidation if you've been saving your whole career and you're getting ready to make this transition to not being able to generate that income anymore, and having to live off of the portfolio that all of a sudden is down 10, 12, 15% from its prior highs. And that's why I think it's important to look at some perspective, again, keeping that long-term time horizon in mind, because we just don't know what's going to happen in the market over 12 months. We can lay out different scenarios and we can sharpen the pencil as we get further into the year. But what this chart illustrates for us is over a 1-year time horizon dating back to 1950. If you're an investor, your range of potential outcomes is very high, very wide. Could be very poor, could be very great. If you're in equities, if you're in bonds, I think we just set the new record low for bonds at minus 13% on that blue bar. And then diversification has a way of sort of mitigating the upside and the downside and giving us a more predictable result. But the messaging here is when we retire, we don't take out all of our money from our retirement plan, stuff it under the mattress, and then pull a few dollars out to live off of every day. We're still going to have a 20, a 25, a 30-year time horizon when we enter retirement. So it's important to look again back at those capital market assumptions and back here at history, when we can see that the further out we go over 5 years and 10 years and 20 years, the odds are much more in our favor of staying invested and staying the course. But if we look at the next page, it is important, I think, to have a plan, to know and execute that plan. In time of crisis, you don't want to develop your plan when things are already on fire, right? You want to have that crisis plan already in place so you can execute it. And that's where I think people can take some proactive steps if you are getting ready to retire with a little bit more comfort and a little bit more ease. And the way I kind of prepare this as an analogy is when we're working, we all know that we need 3 to 6 months worth of living expenses in an emergency fund, right? That's kind of the financial 101. We want to have an emergency fund in case something happens. Or maybe we want to have disability insurance in case we're too sick or too hurt to work. Well, we're not working anymore. Our portfolio needs those same things. It sort of needs some disability insurance in case it gets too sick or too hurt to work. We go through a recession or a bear market. That portfolio needs that extra cushion. But maybe instead of 3 to 6 months, we look at a 1 to 3 years worth of retirement income distributions that we can put into this more conservative bucket to satisfy our short-term needs. And just even that mental accounting of moving that money over to a money market, a stable value fund, or some short-term treasuries, which we'll talk about here in just a minute, can allow us to look at the rest of our portfolio with the right vision, with the idea that we're keeping a 5-year time horizon in mind, or a 10-year or a 20-year time horizon in mind. So we're not selling assets when they're down in value. So developing this strategy, we call it a bucketing strategy, that's something our advisors can help you with, whether you're a retirement plan investor, individual investor, to take the guesswork about where your next 12, 18, 24 months worth of income is going to be sourced from, and help us keep the right perspective on long-term investing. But I did want to comment just very briefly, this last slide here, and I'll turn it back over to you guys, is we do have an opportunity now that we haven't had in 15 plus years. And when I give that same advice for years about creating this bucket strategy, and I had to tell somebody that, hey, we need to take some money out of this investment portfolio that's averaged a 10% return out of the last 10 years. And we need to put it in this vehicle that's paying 0.1% over here on the sideline so we don't lose money. So we've got that safety net. It wasn't very appealing to a lot of people to overfund that emergency bucket. Well, now our emergency bucket's working for us. That's kind of the benefit of these interest rate increases, is we can get nearly a risk-free rate of return in 3 months treasuries of 4.6%, or 1-year treasuries at 4.7%. CDs are viable investments again. So there is an alternative to accepting a high level of risk with those more short-term buckets in our portfolios, and frankly, to even drive the diversified returns that we need for those longer-term buckets when we have this opportunity in the fixed income market. So again, it's about having a plan that's in place. Work with our advisors. We can help with that to make sure that you're comfortable with what those next couple of years look like, and set up the next 25-year roadmap for you.
Yeah, thank you, Eric. And I'm going to come back to each of you with kind of a closing action item, some closing action item thoughts from each of you before I ask you to share that. And over the next couple of minutes, I think it's really important for us to help people to think about looking forward. And one thing that really stood out to us, Eric, Scott, and I have each talked about how there are now higher expectations for market performance as we move forward, in part because we've taken all of that pain that was expected to be felt over a long period of time, and we smashed a lot of that into a shorter period of time. And when JP Morgan updated its long-term capital market assumptions late last year, this really struck us in the opening letter, a recitation of all the challenges that we've experienced within the economy and the financial markets in 2022, and recognizing this final sentence: amid these cascading crises, many of the past year's losses have created significant opportunities. And then going on to read JP Morgan explaining to us that our assumptions now looking forward are very different than they were a year before. And the idea, as Eric pointed out earlier, that those expectations have moved from 2 to 4% in the equity markets back up to 5 to 7%, and the expectations within bonds or fixed income have greatly increased. And so we hope in talking through these today, we've put each of you in a position to understand how, even though we've got headwinds, even though we see in front of us the potential for a recession, even though we expect some further challenges within the marketplace, why things look better as we look ahead. And so I think both from Eric and Scott, if you could each share 30 to 60 seconds of your pitch to people, what should they do now? What should somebody do next after listening to this and thinking about their short-term, long-term financial future? What should they do? And I'll let you guys fight over who goes first.
First.
Go for it.
Oh, you were already off mute. I thought you had it. So I think it's kind of a reiteration of what we just covered to a degree, of just making sure that our portfolio is aligned with our objectives, the actual income objectives that we have. So if we can set that up into tranches if we're closer to retirement, but it's quite simpler if you're young, right? If you're in accumulation phase, whether we buy it just right at the S&P at 3,900, or if we have to buy it again at 3,600, and maybe even again at 3,000. It's time to accumulate. It's time to accumulate. This is where you make your long-term investment returns, by accumulating assets, buying more shares in that 500 index fund of Apple and Amazon and Google and Walmart and Procter and Gamble. These opportunities aren't around every few years. The market generally goes up and to the right. Those charts, they all look the same. 75% of the time the market's up. When it's down, those 25%, you want to take advantage of it and be aggressive with your saving as best you can. But don't go, there's no need to speculate either. There's no need to get cute and try to pick your 5 favorite stocks that you think are just, Bed Bath & Beyond might come back. Stay diversified in your approach, and should be rewarding over the long term from here.
Yeah, I think that's well said. And I would also point out that Eric eloquently described this in his final slide, but I would caution, for those investors that are more conservative or closer to retirement, during these uncertain times, going to cash might seem like the safest bet. But to Eric's point, you have very high quality short-term fixed income options that are cash-like, they're yielding 4%. So I would encourage anyone to reach out to their advisor and have that conversation, because you could very easily be paying the opportunity cost of missing those short-term high-quality opportunities by having too much just in cash. Case in point, the 2-year U.S. Treasury yield is 4%, and that's about as cash-like as you can get. And so I think it's a great time for individual clients or plan sponsors to re-engage with the advisors and just make sure there aren't opportunities being missed even for the conservative investor. In addition to the point Eric made about the longer term, more risk-seeking investors or the risk-seeking buckets of the portfolio.
Yeah, and I always think this is like a really good opportunity for each of us to create work, but actually create conversations for our advisors, right? What a perfect time to have that conversation. And so we would ask that each of you feel comfortable, reach out to us, whether you've got an individual advisor who you work with, or you work with our retirement plan services. Perfect time. Send an email, make a call, get an appointment set to have that type of conversation about your portfolio. And then the last thing we'd ask you, just continue to join us for these educational offerings. We have more than this coming up. We thought we'd just show you a couple of different options. As I mentioned earlier, we've got a deeper dive on the Secure 2.0 Act coming up next week. We have throughout the entire year a 12 offerings of the Fit for Learning financial wellness webinars, where we invite all of you to be a part of that and to talk about current and practical financial topics for you. And then many of you are starting to get the emails from us about our large annual event, the Qualified Plan Fiduciary Summit. This will be our 15th year of that. We're incredibly excited, and we're all in on the planning for that event, and hope that many of you will take the opportunity to join us as you have in years past. So we're going to wrap up for today. I once again want to say thank you to Scott and Eric for lending your expertise and for the conversation today. And then thank you to each of you for taking the time to join us. We greatly appreciate it. We want to continue to provide educational offerings, and the more of you that take part in this, the more that we'll keep coming back with additional content. So enjoy the rest of your weekend, and again, thanks everybody.